All right, guys, welcome to the Buff Show. We have an episode where we're going to be covering Section 121 of the IRS tax code, going over the primary residence exclusion. So,
The goal is to talk about basically capital gains. That's something everybody kind of worries about when they're selling a property is, are we going to owe a bunch of taxes off of the equity that we've made on the property? And so we're going to just kind of briefly, we're going to probably stay pretty shallow on it. We're not
Yeah.
going to dive too deep since we're not accountants and
yeah,
CPAs. So
yeah, this is not tax advice. This is just our understanding of the rules. So let's, I guess, define what a capital gain is on a property. So capital gain, how I would define it is like if you bought, it's based on the purchase price of when you bought the property and what you sell it for. So if I bought a property for $250,000 and I sell it a few years later for $500,000, I had a gain of $250,000. People confuse this with like what they owe and what they sell it for, and it's not what you owe. It's what you originally paid for it and what you sell it for.
And there is an adjustable basis in there that we'll get into that and we'll talk about it.
Yeah.
The basic, So if you, depending on how you file your taxes, you can either qualify up to $250,000 tax-free gain or $500,000 if you're filing together jointly of tax-free gain.
And this is just on your primary residence. So a lot of people will be like, I'm selling my home and I think I need to do a 1031 exchange. You can't do a 1031 exchange on a primary residence. That's why they've kind of came up with this code. 1031 exchanges are for investment properties that you've been renting, and it's a raw land or a commercial building or a duplex or a single family house that you rent. Like it's something that you're not occupying and claiming as your primary residence. So they came up with this cheat code to help, I guess, families to where if they did have some gains, which almost everybody does when they sell a house and they've lived in it for a few years, that gain is not taxable if you meet certain requirements. So we're going to go through over this section 121, hopefully answer questions. You guys just sold a house that was a primary residence.
Yeah. So our story personally, I guess we bought a home. We knew it was going to be more of an investment for us. We did live in it. We gutted it, remodeled it. Anyway, we were going to flip the home at first, decided it was a good way for us to get into the market, and we used it, and we were able to get the remodel done fairly quickly. And then a new purchase opportunity came up for us that allowed us to turn one door into two. And that was the whole goal of the property from the beginning. And so we ended up going and talking to our accountant just to make sure that we were good with our capital gains, just to clarify some questions that we had. And basically what it came down to is we hadn't quite lived in the home for 2 years. So to qualify for this 121 exclusion, you have to occupy the home for 2 years out of the last 5 years. That can be at any point in time in the last 5 years, but you have to occupy the home for minimum 2 years, some point in the last 5 years to qualify for the 121 exclusion.
Yeah.
And then with our personal home, we had that understanding, but we wanted to see if, I guess, our adjustable basis, if that would get rid of our capital gains, essentially, but it didn't quite. So anyways, to just qualify for the 121 exclusion, as long as you have lived in the home and you've owned the home for 2 out of the last 5 years, you can then see if you qualify and get some tax-free gains.
Yeah. And the tax-free gains, so if you have lived in there 2 out of the past 5 years, if you bought the house 2 years ago and you've lived there the entire 2 years, that's about the fastest you can do that
That's
process.
exactly what we did.
Yeah.
Yep.
You live in there for 2 years and then you sell it, you get that tax-free gain. And you get $250,000 of gain tax-free if you are single, or up to $500,000 if you're married and if you're filing jointly. So $250,000 if you're single, $500,000 if you're married and filing jointly. And you must have owned and used the home as your principal residence for 2 out of the past 5 years preceding the sale.
The crazy thing is with our last sale is, like I said, we went and talked to our accountant, and just us waiting to list our property, I think we ended up having to wait about 2 months before we listed it, saved us about $25,000.
Wow.
Because our capital gains would have been about $25,000. We wouldn't have owed it right then. We would have owed it the next year on our taxes.
Right.
But to think about, that's an automatic that you owe them $25,000 on your taxes is a lot.
Yeah.
So
I want to cover some of the key points, and then we can talk about the basis. So the key points: ownership and use test. So you must have owned and lived in the home as your main residence for 2 of the past 5 years. These 2 years don't need to be consecutive. And I'm pretty sure you can have even rented it during that 5-year period. So I've had clients where one that I can think of in specific, he's actually an accountant, and he rented it for 3 years and they owned it for 5 years. So they rented it. They lived in it for 2 years, moved out, rented it for 3 years, and then they're like, well, now's the time to sell it. And so he got some rental income from it, and then sold it, and still got the $500,000 of tax-free gain from selling the house. So
the one thing to keep in mind is you can only do it once every 2 years.
Yes.
So if you have multiple properties and you're
bouncing around
and living in multiple properties, you can't use the 121 exclusion. If you sell 2 properties within a year, you can't use it twice. You would probably get hit with the capital gains on the second one.
Yeah.
It falls before the 2-year mark of the previous sell.
So like a good example of that could be like, we just moved out of our Eden house. We bought another house in Eden. So we've lived in there like for 3 or 4 years.
Mhm.
If we live in our next Eden house for 2 years, I could technically sell either one of those and claim this exemption as long as I hadn't done another one. And I would say if that's the case, I mean, rarely is that does it come up? But if you are deciding, I would just decide between which property has the most gain that you would want to shelter the tax burden from.
For sure.
Exceeding, so frequency, exceeding the exclusion limit. If your gain exceeds the exclusion limit amount, the excess is subject to capital gains tax. So there have been a few clients where they're like, hey, we have over 500 grand in gains here. What do we do? And I'm like, well, I'll just charge you more on commission. No. I say that as a joke, but that's where we really dive into their basis. Like, okay, well, what's other things? Are there other improvements that you've done to this property that we can add on top of your initial purchase price? For example, our Eden house, like we bought it for X, and then we did about like $300,000 worth of improvements. So I can add that in addition to our original purchase price to have that new basis price.
We had a listing, actually, just we're on a contract on it, but we had a listing where they were kind of worried about this because they've owned the home for a long time. They refinanced and pulled some cash out to do a large remodel on the property. And the big question was, well, they owe now a new amount, and then does that count towards, can they use that as a basis adjustment, or can they not because it's a new loan? And the answer is yes. If you have done, even if you've taken a HELOC, or if you've refinanced and pulled cash out to do a remodel or to improve the property in any way, shape, or form, as long as the property is improved, then yes, that counts towards your adjustment of basis. So you're able to add whatever the purchase price of the home was originally when you first bought the home, whatever adjustments or upgrades or updates, whatever like that you've done to the property, those can be added to that number to help shrink that difference from the sell price to the purchase price.
Yeah.
So
this is a huge like loophole, and I see people like almost every transaction, sellers are taking advantage of this.
Yeah.
And most of the sales, like when you go to a title company here in Utah, they're like, well, just because it's over 500,000 sales price, we're going to have to report it to the sale to the IRS. That doesn't mean you're going to be taxed, but then you can work through this with your accountant and say, okay, like this is what we bought it for. Like we had this much in gains, or we were 1099 this amount, but then you can write off a lot of it or all of it, depending on these rules that we just went over. And I'm starting to run into it more where, maybe it's a single person and they only have 250 in gains. Like that's pretty easy to blow through, which is how fast our market's appreciated and things like that here. And I've even seen some clients go over the $500,000 mark where they're like, shoot, we're going to owe taxes on this amount. And that's where get with your accountant, because I think there are ways you could get creative. Kate was just saying there might even be a way that you can do 1031 exchange on the excess if it's been like a dual purpose property.
I don't know all the rules on that. So
Yeah.
definitely like meet with your CPA, talk with them, figure out what the best route is for you. The nice thing to know is that if you exceed that gain limit, whether it's 250,000 or 500,000, depending on how you're doing your taxes, you're only hit with capital gains on the portion that exceeds it.
Yeah.
So you still get that 500,000, that $250,000 of tax-free gain, which is nice. So sometimes you got to outweigh the pros and the cons. Like if let's say you make $520,000, right? It might be in your best interest to just pay that capital gains tax on that $20,000 and be able to sell your home and move on and do whatever it is you need to
for
do.
Sure, yeah.
Versus waiting 6 more months or something like that.
Yeah.
You know what I mean? So every situation is going to be very personal. And I think you just need to reach out to your agent, but also your CPA and talk with them and figure out what's best. But
this rule becomes hard when you're like we have properties that we lived in and it's like, well, we kind of want to keep it as a rental, but if you rent it long enough, you lose that exemption. So I've utilized this exemption once on the sell, but then all of our other properties we bought and lived in, we've just turned into rentals. And so I basically am just like,
you can't use it on those ones.
I can't use it on those ones now.
So the best thing for you to do would be a 1031 on those.
Now, because we've rented them long enough that they now classify as an investment property. Right. Yeah. The one that we're not unsure on is that Eden one that we just moved out of. But I hadn't thought about it. Now we have 2 houses that I'm like, I could really sell either one in 2 years and see which one makes more sense or just keep renting it. So it's a cool strategy. There's a lot of strategy here. I know you're working with some clients that they're doing a lot to figure out how to get, because they're exceeding that 500,000 limit by quite a bit. And they're like, we don't want to have to pay tax on $1 million. And they would almost prefer do the 1031 exchange. So they're trying to rent it and get past that period so that they can just do a 1031 exchange. But you have to realize a 1031 exchange, you're just deferring the tax burden down the road. Yep. Well, you're not saying you won't ever pay it.
Yeah. It's just you still owe it. It's just down the road. And so the only way you can get rid of it is if you own the property till you die.
Yeah.
And then that goes into a trust. But yeah, like there's definitely situations where it's best to avoid the 121 exclusion and do a 1031 depending on how much capital gains you may be paying.
I think for most people though, this 121, this is like awesome. And hopefully they up it here soon, just because I feel like
they're trying.
It would be good, especially for the single owners. Like 250 grand is.
There's just been so much equity gain in the last 5 years, 4 years, really. You know what I mean? And so people are the 250 mark, especially, but even the 500,000 mark, like it's not unthinkable to have more than that in your property.
And if you're married and you don't file jointly, like file jointly, or if you live in a house,
if you're planning on selling anytime soon, start filing together.
Yeah. Well, I mean, these are little things to think about. Or if you live in a house and you change the ownership to a LLC, like don't do that.
Yeah.
Right. Because like you're changing, like that's like a sell almost. So there's just things that you got to keep an eye out for. But again, get with your accountant. We kind of gave you an overview, and this is a really cool way. Like, can you imagine if people had to pay tax on that, how much taxes that would be?
It would hurt a lot of people.
Yeah.
I mean, people wouldn't be able to do it. They wouldn't be able to sell the property because they would, truthfully, people would probably get creative and find a way around it somehow. Yeah. You know what I mean? Like they would get creative. We always do. But
well, and I've seen a lot of wealth be built on this. Builders and like just clients of mine, friends that are like, hey, every 2 years, like I want to keep that clock as close to that 2-year mark as possible, where they'll buy a house that needs some work, they'll fix it up, live in there for 2 years, get that tax-free exemption, sell the property, buy another one, do that all over again. And it's just like, one after another after another. And they're building like a lot of wealth just through that transfer.
It's cool as you get your down payment back and then you get whatever equity you put into it back to you. So it's a way to make money by just owning property.
Just snowballing, tax-free money.
Yep.
Pretty sweet. Well, hopefully that was insightful. If you guys have any other questions, reach out. Until next time.
Thanks, you guys.